the sales increase. It has a positive relationship with sales. Okay, positive relationship. Okay, you know what? How do I mention? When I say positive relationship, okay, it actually means when product X increases, product Y will increase. Okay, if it is a negative relationship, okay, when product X increases, product Y will decrease. Okay, this is the Y will decrease. Sorry, that's it. Okay, product Y will decrease. Okay, now this is positive and negative, and there is another which is no relationship. Okay, so in our case, sales and fixed cost does not have relationship. Okay, there is no positive or negative relationship, so it is not significant. It does not have correlation. Okay. Now the third step. We have finished the first step, which is forecasting the sales figure. The second step is developing the pro forma statement. The third step will be preparing the balance sheet or the pro forma balance sheet. So very simple in this profit planning. Very simple. There are only 3 steps. Okay. Okay, probably the best approach to use in developing the pro forma balance sheet is using the judgmental approach. Okay, the judgmental approach. The judgmental approach is very simple. You just minus the asset side with the total liability side, then you will have an imbalance figure, which you will consider as additional funds required. Okay, that's so simple. Okay, under this simple method, the value of some balance sheet accounts are estimated and the company's additional financing requirement is used as the balancing account. Okay, right? I know that majority of you are so good in balancing the account, especially using plus in figures. Correct or not? Yes, I know it. I've taught accounting 2, accounting 1, so I know it. Majority of you just plug in the figure to get the total asset and liabilities balance. Okay, I don't know where do you get the figure. Okay, now to apply this method to a vector manufacture, a number of simplifying assumptions must be made. Okay, remember the first slide with the first 3 slides, right? Mentioned about the 3 steps, the 3 important factors which are being used in developing the pro forma statement, which are the information required, okay, from the preceding year. The second one is the forecast. The third one is the assumption that you should meet or be given to you. Okay, in our case, the assumption will be given to us. Okay, assumption will be given to us. Okay, now let's see the assumption. The first assumption is a minimum cash balance of 6,000 is desired. Okay, which is our assumption. So in our balance sheet, our cash balance will be 6,000. Okay, very simple as that. Okay, marketable securities will remain at the current level of 4,000. So our previous year, the marketable securities is at 4,000. So this forecast year will be 4,000. Account receivable will be approximately 16,875, which represents 45 days of sales on average. Okay. Now, if you look at this, if you are not given here, right, this is the answer, right? You might have some problems in getting the figure for account receivable, right? So, actually, you can use your knowledge in ratio analysis to get this figure. Okay, if we know that, what is the formula for account receivable? Not account receivable, account average collection period. Okay, the formula is account receivable divided by sales, then you multiply with 360. We do not know this figure, right? Account receivable. Okay. ACP has been given, which is 45 days. Okay. Sales has been forecasted, which is 105,000. 360 is already. Okay, so can we get this figure? Account receivable. Yes, right? So what we do is that we use mathematics equation, transfer this account receivable to the left, and then this ACP to the right. Okay. Now let's see how we are going to transfer this. Now our ACP is 72 equal to AR divided by 135,000. 45. Okay. 45 times with 360. Okay. So now, if you look at this actually can be transferred here, right? So when this is multiplied, and you transfer to the other side, it becomes okay, we must divide it, become as you know, denominator, right? So 45 divided by 360 equal to account receivable divided by 135,000. This actually we can bring it to the other side, right? Okay, so 45 360 times with 135 is equal to account. Is it the same? Okay, you are using 360. Okay, we can continue on for a while. Okay, now that is for account receivable. The next one is ending inventory. Okay, ending inventory will remain at 16,000. Okay, which is 25%. 25% represent raw materials. 75% represent finished goods. Okay, so 25% out of 16,000. Okay, you take 25% times 16,000, you get 4,000, right? And then 75% you times 16,000, you get 12,000. So that is the breakdown of your ending inventory. And then the next one is a new machine costing 20,000 will be purchased. So it says that we are purchasing a new assets, right? Total depreciation will be 8,000. So the total depreciation is 8,000. Adding 20,000 to existing net fixed asset of 51. So our previous balance of the fixed asset is 51,000. Plus with the new asset that we acquire 20,000, we get total asset of 61,000. 71,000, right? Okay. 71,000. Okay. 51 plus 20. 71,000. Then you minus with total depreciation, you get 63,000. That is your ending fixed asset on net fixed asset. Okay, any question on the fixed asset? Any question? Okay, now I'll show you how to get it. Okay, now our beginning asset 51,000, right? Then we plus with additional asset acquire, okay, 20,000. So this is your total asset, okay, total new asset, total new assets, right? But this one we will not include directly into the balance sheet. We have to less with depreciation. So we left with total depreciation, okay, which is 8,000. We have a total figure of 63,000, which we consider as net fixed assets. Okay. Alright. Next one will be, next assumption is purchases will be 40,500, which represents 30% of annual sales. Okay, so it already mentioned that purchases is 30% of the annual sales. Lecture takes about 72 days to pay on its account payable. As a result, account payable will be equal. Okay, this one you will be also using the financial ratio formula, which is called APP, right? Account average payment period. Okay, we use APP. Okay, the formula will be account payable, right, divided by purchase, okay, times with 360. Okay, how do you want to get this one? Okay, we just transfer the rate as what we have done before. Okay, how to transfer? I'll show it again. Yes. Okay, now 72 days. This is 72 days. Account payable we do not know, right? Purchase is 30% out of 135,000, which is 40,500. Okay, then you times with 360. 360 you bring to the other side, which is equal to 72 divided by 360, equal to account payable divided by 40,500. This one you bring to the other side. Okay, 372 divided by 360 times with 40,500 equal to account payable. Okay, then you can get the account payable figure, which is put 8,000. So any question on this? Okay. Okay. The next assumption is tax payable will be 455, which represent 1/4 of the 1998 tax liability. Okay, if you look at the tax liability in 1998, $1,823. Okay, we take the 1,823, this one, okay, times with 25%, right? You get 455. This is your tax figure, tax liability. Go back to slide. Okay, tax payable. Okay, this tax payable you haven't paid. Okay, you haven't paid. You have to pay. So this is will be considered under current what? Under current asset or current liabilities, tax payable. Current liabilities, okay. Okay. The next assumption, notes payable will remain unchanged at 8,300. This one you don't have to do anything. Okay, it is the same figure. Okay. Will remain at 8,300. Okay, there will be no change in other current liabilities, long-term debt and common stock. Okay, these are also information given that these items also, these accounts also do not change. The last one will be retained earnings will change in accordance with the pro forma income statement. So because retained earning, you have the previous retained earning plus net profit, then you left with total cash dividend paid out, then you can get the balance of the balance of your retained earning for that forecast year. Okay. This is the example of the balance sheet. Okay. Example of the balance sheet. 6,000. This is the same. 4,000 also the same. Account receivable derived from our calculation just now. Okay. From average collection period. Raw material 4,000, 12,000. This is from the segregation of 25% and 75%, right? From 60,000. And then we also have the net fee assets 63,000 from here. Okay, 63,000. Total asset will be 105,875. Okay, this is very simple. You only have to do this, and also day. So 1, 2, 3, 4. The rest remain the same. Okay. And then for liabilities and stockholders' equity, account payable, this is the same, right? 1,100. Tax payable, you derive it from the tax figure from preceding year. 20% time with the tax figure, you get 155. Notes payable also the same. No, this one is from our average payment period. Notes payable, which does not change. Okay? Notes payable does not change. Other current liabilities also does not change. Okay, long-term debt do not change. Common stock did not change. Retained earning have some adjustment that we have to do. Okay, this retained earning. Now I will show you how you get this retained earning figure. How you get this retained earning figure. Okay, when we prepare the statement of retained earning, okay, we have the beginning balance. Okay, where do you get this balance? Beginning balance from the preceding year balance sheet, right? Okay, which is how much is the retained earning? 23,000, right? 23,000. Okay, the formula for the statement of retained earning plus net profit, okay, after tax, okay, then you minus with cash dividend paid, right, to common stockholders. Okay, now net profit after tax. How much is our net profit after tax? Which we have already forecasted for the our pro forma income statement. How much from the pro forma income statement? 6,358. 10,300. 10,327. Okay, cash dividend 4,000, right? 4,000. Okay, how much do you get? This is our balance of retained earnings. 23,000 plus 10,327 minus 4,000. You get 29,327. Is it the same? Yes, it's the same. Okay? Right? It's the same. Now, if you focus on this side, on this liabilities and the stockholders equity, okay, you can see that the total asset and total liabilities and owners equity did not balance. Okay? It does not balance. If we total up this one, okay, we only get 97,582. Okay, compared to our asset side is 105,000. So how to balance this figure? We just minus, then we get this external financing required, which is 8,293. So if it is a positive, okay, if you minus from the total asset, it is positive, then it is actually external financing required. But if it is negative, then we have actually excess funds. Now then only we can get a total balance of 105,875. Okay, any question on this? Any question? So you do have to have plug in figure to balance the balance sheet. Okay, but you do that only with the pro forma balance sheet. Okay, using judgmental approach. Don't do your accounts with your plug-in figures. Okay, that is not correct. Okay. For your accounts, accounting major, I know a lot of this class is are from the accounting major, right? So don't do that. When you do your accounts, you don't just plug in the figures to balance to get the balance. It's not balance, then it's not balance. Okay, now evaluation of the pro forma statements. Okay, we know that these pro forma statements, right, the pro forma income statement, the pro forma balance sheet, are very simple to be developed, right? Is it simple to develop? Right, it's very simple to develop. So when we have simple things, okay, we have weaknesses, right? When we do things simple, we have some weaknesses. Okay? So what are the weaknesses of this simplified approach? Okay, the major weaknesses of the approaches to the pro forma statement developed, okay, there are two weaknesses. First one is that the firm's past financial performance will be replicated in the future. So in our assumption, we assume that the history will repeat. Okay, the history will repeat. But not necessarily history will repeat. Now let's say one example. This is an analogy. You are going to this class, right? From the university at night, during the night, because you have missed your first bus. Because you want to attend to the final class. Okay, because if you do not attend the class, then you get a 0, right? So you try to run. Then you start running. Okay? Then suddenly you step on pile of dog shit. Okay, you know dog shit. Okay, you step on the dog shit. Okay, so that is when you come to the class, so you have to wash before you come in. But still there are some smell, Okay, okay. On the way back, you also miss the bus again. You miss the bus again. Okay. You miss the bus again, and then because of you have missed the bus again, you have to walk. Okay, do you think that you are going to step on the same dog shit again? No, right? So you will try to avoid it, right? So sometimes history will not repeat. Okay? So this assumption that says that history will repeat sometimes does not reflect the true picture. But this is our assumption. Okay? So I'm just saying that this simplified approach, because we assume that history will repeat, but sometimes history will not repeat because of we try to avoid the history. Okay, we try to avoid the past history. Okay, and especially the back history. The back history. Okay, and then the second one is that certain accounts can be forced to take on desired values. Right? For example, you look at the minimum cash balance. We force the cash balance to be 6,000.